Thank you for joining us today. It is the 8th of October. My name is Joe Terril, president of Terril and Company, a private wealth management firm in St. Louis, Missouri, with about $760 million of discretionary funds under management. We'll be discussing recent events in the world economy and what we think the implications are for the markets. And Brian, I appreciate you helping us today, and let's go to maybe a brief discussion about the world markets.
Okay.
World economies have been worrying for the last couple of years about events all over the world, everything from bankruptcy in Greece to potential conflicts between China and Vietnam arguing over international waters. Obviously, civil war in many of the Middle East countries, Russia, Ukraine. These are all events that so far to date have not actually affected the world economy. But now perhaps we're in a new area of the economy where sanctions against Russia seem to be having an effect on Europe and slowing down Europe's economy. A year ago it looked like Europe was coming out of recession. Now maybe with the sanctions against Russia slowing down that European economy, perhaps Europe is going to go back into recession. One of the things that at Terril and Company we're most concerned about is what's going to be the effect of the U.S. dollar and the strengthening U.S. dollar on the world economy. After years of being the weakest economy in the world and continuing to fall in value, we've now entered what is probably going to be a new phase that's going to last for some time, and that is the U.S. dollar is going to be strong and strengthen against the euro, against the yen, against other currencies around the world. The rationale and the reasoning for that is our economy in the United States is as good or better than most economies around the world. We're somewhat distance-wise removed from a lot of the geopolitical tensions that are going on around the world. And we also have some expectations that maybe our interest rates are going to go up in the next year or two, which would also allow holders of dollars to make more money. So why don't we move a little bit, Brian? I'll just sum up that the world economy definitely seems to be slowing down somewhat. Is it enough of a slowdown that it's going to have meaningful effects on investment markets? And what will be the effect of a strengthening U.S. dollar on investment markets? This will be determined over the next year. But let's move on, Brian, and maybe now we'll begin to talk about interest rates and the investment markets and what we anticipate is going to happen in the next 6 months to a year. Investment markets have been aided in the last couple of years by the fact that we have had zero interest rates. There's been nowhere else for people to go with their money. You cannot make any interest of any consequence safely. Consequently, you've seen money flow into stock markets around the world, and in particular the United States stock market, again being perceived as one of the largest with the most liquidity, with a lot of world names known. That investors all over the world know those names, know those companies. So zero interest rates have really been the champions, so to speak, of the investment markets. And when things like banking problems in Europe come along, the market gets worried. You come back to markets make new highs because there's nowhere else for people to go with money. You have the recent scenario with Russia and the Ukraine, and that drives markets down, but yet markets come back and make new record highs later because of this zero interest rate policy. So I sort of look at this as zero interest rates around the world has been the champion of the market, and any number of things in the last 2 years have challenged the champion, but yet zero interest rates has defeated them all. And just last month, markets around the world, particularly in the United States, made new record highs. But that's history, and we're now into a period where at Terril & Company we believe that perhaps this strengthening U.S. dollar and some of the geopolitical events are going to have enough of an influence that maybe the investment markets are going to struggle for a time being. A stronger U.S. dollar will definitely lower corporate profits for most companies doing business in the United States. A slower economy around the world will not help either. So we're very cautious at the moment on October 8th of 2014 about how the market is going to balance. Yes, we still have zero interest rates. We do not believe interest rates are going to go up. If anything, they're going to stay down, maybe even go lower. So we still have the zero interest rate policy that's been the champion of these markets. But we believe this new challenge of how is the market going to react to a higher U.S. dollar and the slowing around the world in the economy that this is beginning to create, and what will happen with investment markets. We think markets will probably end up perhaps in the next year 5 to 10% lower. They will not be able to overcome this, and therefore the zero interest rate policy that has driven markets at this point is maybe finally met its match in the fact that a strong U.S. dollar, perhaps even getting stronger, will upset that apple cart for the time being. So with that said, we want to stress we're not looking for a crash in the markets. We're not looking for markets to go down precipitously like they did in 2008. But we do think maybe in the next 6 months to a year, markets can run into some difficulties, and therefore it's time to be much more cautious, particularly with equities, than what we've been over the last 3 to 4 years. Brian, thank you for helping us film our latest updates, thoughts on the economy and market. We'll probably be back as events necessitate or in about 30 days. Once again, I'm Joe Terril, president of Terril & Company, private wealth managers in St. Louis, Missouri, and we'll see you next time. Thank you.